All right.
Well, it tells us that it's being recorded.
Okay. So this is our final capstone presentation by John, myself, and Luke. So our strategic vision, when we sat down to make this from the very beginning, this was kind of one of the things that I think, took the most time on because we wanted it to be something that really got our point across. So our company's vision statement is to create a comfortable environment for all creative people who are looking to change the world one camera and drone at a time, to allow each and every individual to have the potential to grow and develop new ideas with high quality, competitive pricing, and even better service, to keep our customers involved and satisfied with the products that we produce for them.
So some of our performance targets for the next few years are EPS at a 5.2, our ROE at a 16.5, our credit rating A+, our image rating a 95, and our stock price $67.30. And we worked pretty hard on getting our credit rating and our image rating up by not taking out like a lot of loans and stuff. And our image rating, we tried to steadily improve our products, like the camera and the drone, over the few years by just like adding in better parts and like messing with warranty periods and just stuff like that to get it up as high as we could. I'm sorry, I think I disconnected. Can you guys still hear me?
Yes.
Okay, so yeah, really sorry about that. But some of our competitive strategy for our cameras. For our sales forecast, we underestimate how low our competitors dropped the pricing. We thought we had one of the better prices, however, it ended up dropping our sales because of it. Our main targets were North America, Asia Pacific, Latin America, and Europe, Africa. Our top consumer was North America for cameras. For Asia Pacific and Latin America, we did not sell as much product, so we worked on improving our marketing, such as website displays and advertising. We based our pricing on each area with their currency. However, our competitors were pricing and how much the product we sold in each area. For future marketing opportunities, we worked each year to slowly increase our marketing perspective, and we tried to find a good common ground for each country. In the 3-year plan, from years 9 to 11, at first, we chose global low-cost leadership strategy and global best-cost strategy because we had a competitive pricing but also a high-quality product. After reevaluating in years 12 through 14, we chose to have an undecided strategy because we weren't sure exactly where we stood. We felt as if we had portions of all strategies provided. We wanted to input all of them into how we chose to run our business.
For our strategy for the competitive strategy for the drones, for the first couple of years, we experimented around with what would work best, but we slowly started to establish ourselves as a very low cost leader with also a pretty decent quality for our drones, and we started taking over a large market share of the drones being sold. As we went on, our costs got even better in terms of comparison wise towards the other companies, and we established ourselves as the global low cost leader in our category, and we had little to no competitors in that price range for a little bit. We tried our best to keep the marketing low and lower the cost of our products to make sure we were being sold as lowest. At the same time, though, whenever our products were underselling in like certain region or anything, we'd higher our marketing costs just to make sure that we would still maintain our lead there. For our production strategy, every year we sat down just to make sure that we didn't have much overtime running. We wanted to make sure our employees were able to get their work done, and we didn't want to run too much into overtime and to do that, we made sure that we added a lot of extra workstations and installed a lot of more workstations too, just to make sure that we had enough like actual space to get everything done. And early on, we tried to expand our workstations to have the robotics factor, just to make sure that we could maximize the amount of work done per workstation. And we figured that's something that you upgrade once and then you'll have for like the rest of your time in the company. And so we tried to get this done early just to kind of maximize the amount of value we can get out of that. In terms of the research, though, for the cameras and drones, we kept it at a steady rate, about $3,250, and we didn't really put much more into that or take much out of it. We just kept that at a steady rate just so we could get upgrades.
So for our finance strategy, something that we looked at the most was our stocks. However, we did wish that we would have kind of looked into it earlier, because we didn't really do it until a couple years in, and it kind of affected us a little bit. But when we did start to realize that we needed to repurchase the stocks, we tried to do it when they were at like the lowest price. So we weren't spending too much of our ending cash on them. However, our credit rating was something that we looked at from year one. We wanted to make sure that when our customers were buying our products, that our credit rating was really high. And we worked every year to see what affected that rating, and we tried to increase it as much as we could. And we kind of learned what exactly did affect it, and we kind of focused on that to keep increasing it and working towards that goal of increasing our credit rating every year. I think that one of our biggest downfalls we talked about as a company was just not paying enough attention to our debt equity and our earnings per share early on. And I think that if we would have focused on that more in the beginning, it would have kind of set us up for a better ending. And then for our dividend policy, we definitely wanted to pay out a good amount that wouldn't affect our ending cash as much, but still keep our shareholders happy and content with what they were investing in, so they knew that what they were investing in was a good product. And then for our competitors for the cameras, we definitely think that company A and B were our closest competitors. Their pricing was really similar, their sales promotion and how they were advertising, their quality rating was really similar to ours. Even if they weren't as much in the ratings and the rankings of the companies, we were pretty close in the aspect of how we were setting things up. And then just kind of being able to look at that and look at their strategies helped us a lot, because we knew what we needed to like reevaluate and put more effort into and what we lacked on. And that kind of helped us be able to realize, okay, we need to focus on this a little bit more and focus on this a little bit less.
So some competitors for our drones, when again looking at the comparative efforts, company D was a strong competitor for Latin America, Europe, and Asia Pacific. One thing we did notice was we had to change our prices and warranty periods, and we had to change a lot of stuff from country to country due to changing incomes and exchange rates, and there were just a lot of factors in hand that we didn't really think of at first. But over the course of all these years of us doing this, we noticed we just need to change some of them. So when looking at North America, some of the closest companies we had were A, C, and D. It seemed like that was probably our most high-priced market, because it seems like people in North America could spend a little more on their drones, but we would more or less give them a longer warranty period. And although a lot of the companies although a lot of these companies were ranked above us, it allowed us to compare and contrast what areas we need to improve in. And like some of the areas we need to improve in was, one thing I noticed was we would go from being low price and we would sell a lot but not make a lot of money. Then we would raise our price $30 or $40. Then it seemed like we wouldn't sell as many, and all the other companies like A, C, and D would profit off of that. And so we were just trying to find a pretty good middle ground for that. And then some actions to outcompete competitors for our cameras. One action we would take if the simulation would continue to pay closer attention to pricing. Like I was talking about before, pricing is one of the biggest things. It's very competitive. And if someone has a lower price unit with a similar product quality rating, they're probably going to buy that one over yours. So we tried to always make sure our product quality rating was up. We were using good materials, and we just tried to stay competitive with everybody else. When we first started talking, our pricing was much lower than our competitors, so we weren't making many sales. Then we increased it, and then everyone else had lowered their prices, which meant they were buying all of theirs. And we always seem to stay in like a middle ground of product quality rating. Like we'd be like just like right in the middle, and there'd always be someone that would price cut us, and then they would either get a lot of sales due to lower prices, or there'd be someone with a lot higher product quality rating, and then they would get sales because they provided a premium product, but their stuff was really nice. And we just had like a middle ground product, it seemed. And then another action we failed to make at first was advertising web display information. One thing is always advertising. I mean, you look at billboards anywhere, and there's advertising anywhere for anything. And even on websites, even when you like click on YouTube, like you'll see advertising for anything. So that's one thing I'd say we really missed out on within the first few years. Advertising is something you really need to look into, and it can increase your sales no matter like what price your product is. It can really help you out. So that's one thing that we would definitely like to focus on more. And if this continued, we would make sure to reassess it, and yeah, we would just make sure to reassess it and continue on. And another action we would take is to focus on warranty period and sales promotions for each country. I know we fluctuated from, we'd go anywhere from the lowest one, which I believe was 60 days, and then we'd go up to a year. But in certain countries, I would notice like Latin America, if you raised it all the way up, it would lower some of our profits. So we would lower that one to 180 days, and then all the other countries and regions up to 1 year. And we didn't change it too much at the beginning, but as we went on, we adjusted it, and we were pretty happy at the end of the simulation. But if we did continue doing this, I definitely would have liked to mess with that a little more.
So for our actions to outcompete competitors for drones, at first the pricing for our drones was really, really low, and that was kind of our go-to for a little bit because we were selling a lot of product at the point. But we found out that because our pricing was so low for the quality, our profit margins weren't as big as they could have been. So we were selling a lot of drones, but at such a cheap price that we were still making less money than people who were selling less drones than us. So moving forward, we would definitely adjust how much we sell the drones for. We could have definitely increased our pricing and still been the lowest price competitor just based on everybody else's pricing. So definitely we could have raised our prices a little more looking back. In addition to that, for website displays and advertising, like Luke said, that's one of the things we could have definitely improved on. We didn't really take advantage of it as much as we should have. We didn't actually do much advertising, much more than like the standard amounts or the default amounts. And looking back, if we increased our how much money we put into advertising, it could have definitely brought us a lot more profits than we already had. And in addition to that, when we first started the simulation, we had discounts for third-party retailers at a low percentage. We didn't really touch that as much either, but we found out that when we did start messing around with it, it allowed other countries to sell more products than we had in the past. So there were a lot of other countries that we weren't focusing on as much as North America. We kind of focused on North America for a little bit. And then in the later years, we found out that we can mess around with like the other countries and try to tweak things a little bit, and that would help us out with our profits a lot more. For our annual reports, we had a pretty decent credit rating. We were able to keep it around an A to A plus rating for most of the simulation, and we tried to keep it that way. We didn't want to take out too many loans or anything, and we wanted to be pretty reliable when it came to our credit. For our stock prices, though, at the beginning, we kind of experimented with it a little bit, and we set up a we we let out about 5,000 stocks at the beginning in the first year, and I think that kind of stunted our growth a little bit, just because we flooded the market with too many stocks, and because of that, our stock price kind of plummeted for a little bit. And after that, we tried to slowly rebuy our stocks whenever our company stock price was low, just to see if we could recoup some of our losses. And looking back, if we'd started off not doing that in the first place, we might have been in a lot better of a situation. And for our earnings per share, that's another thing we didn't look at quite as closely as we should have. Looking back, if we'd focused on this a little bit more, we might have been able to keep our company ratings up a little bit higher. And that's definitely something we could have worked on if we had another chance to do this.
So something for our annual reports. Our net, as you see with our net revenues, they steadily seem to go up. Um, and we seem to be making a lot more and selling a lot more product over the years as we mess with our pricing. And uh, we, like I said earlier, we were just trying to find our groove and what kind of strategy we wanted to take. At first, we thought about like a low cost leader, but that didn't seem to be our thing. So sticking in the middle of the road was what seemed to work the best to us. And uh, by the graph on the left, that seemed to work decent. And then our our return on equity seemed all over the place because, like I said, like at the beginning of the year five, it was just mediocre, hanging around that like 12-14% that it looks. And then as the years went on, we would like change our materials on our product and uh, and sorry, we would change the materials. We would experiment with marketing. John said, like we mess with our stock prices. It's not on this slide, but that's just something that would configure in there. And then like around year nine, you can see we like raised our prices, but then it didn't seem like we were selling as much. So then that started to go down a little bit. And then into year 15, we seem to just be right around where we started, maybe like a little bit less, but that's how we seem to end. And then for our image rating, uh, at first we were hanging around that like at the beginning it was like a 3 4.0 maybe, but towards the end we noticed our customers liked a higher quality product, so we started raising them. We got into the fours, 4.5, 5, and we started using different materials on our products and for drones and a lot of different image sensors and a lot of different modes for our cameras. And our image rating seemed to go up from it, and the customers seemed to be liking to buy something within the 5 to 6.0 range. And at the end, we had a 6.
I think what Luke was saying. Oh, are you back?
Is that
I'm sorry. I'm sorry. I dropped again. I got really spotty reception. I'm sorry about that.
okay?
But yeah, like I was saying for our image rating, uh, yeah, it just seemed at the end, we noticed our customers liked it within the higher product quality rating. So we just continued to increase our materials and our customers seemed to be buying them and we were happy with what was happening. And if we were to continue on, I would say that I would like to keep improving our product quality, even if we had to put in more money to make our product maybe not make as much in our profit margins. It seemed like more people were buying them at the end, and that's what I think we would like to provide for our customers.
So looking back on lesson learned, when we were talking about it, I think the biggest lesson that we took away from it was definitely paying attention to every little detail. Like John and Luke were saying before, there were certain things that we definitely didn't focus on as much, like our return on equity and advertising. I think looking back, when you are creating a business and you're working on something like this, every piece, even if it seems small, all adds up to that big puzzle. So it can kind of make or break how your business performs that year. And if we would have paid more attention to every little detail, I think that we definitely could have increased our profit margins and increased on how well our business was doing. Another lesson that we definitely took away from this is always assume that you can do better. Obviously, there was years that we felt super confident, super happy with how we performed that year, and then it would come back and we either stayed the same or we might have increased a little bit, but then there was years where we kind of dropped in the rankings, and it kind of upset us a little bit, and kind of we had to take a step back and realize, okay, there's always something that we can change and adapt to and work better on and be able to kind of just change what we were doing and change our outlook on things to kind of create something different that would help our business grow. And then something else that we definitely realized was paying close attention to what our competitors were doing. I think for the first couple of years, we didn't realize that what our competitors were doing definitely affected us. I think we knew that, but we weren't paying as much close attention as we should have. And kind of like they were saying before, if we lowered our prices, they would increase theirs. Or if they increased their prices, we were lowering ours. So just kind of paying attention to what your competitors are doing. I mean, if you're looking at like a gas station per se, and I mean, there's always two right next to each other. What BP and Shell are doing, they're always paying attention to each other, looking at each other, and gas prices are usually maybe 1 cent off, or they're always paying attention to what they're doing. And I think just kind of looking closely at what your competitor's doing kind of really makes or breaks how you're performing as well. And then the last thing we said that kind of was a big lesson that we would be more open-minded about walking into if we would do this simulation again is definitely just being open-minded about what should be changed and what we should improve on. Kind of taking that step back, talking about what steps we can take to either make our credit rating grow, to grow our image rating, to keep our earnings higher, and just improving on what we're doing. Even though we might not be performing well in one area, doesn't mean that we can't adapt to it and allow our business to perform even better than the year before that. So kind of just really focusing and maximizing our efforts to what we were putting in, but also paying attention to the things that maybe we weren't putting as much effort into or putting as much focus on, just making sure that you're focusing on every little detail, like I said before, just really paying attention and knowing that every step matters, I think is just something that we really took away from this simulation. And that is our presentation.